Welcome to this presentation on the benefits of investing in copper and the expected directional movement in copper price. I am Aninda Datta, the presenter. Jai Guruji, Shukrana Guruji. Here we will evaluate the following areas. The commodity pricing equation establishing the relationship between the spot price and the future price, the contango and the backwardation price curve. The usual shape of the copper's future price curve and the factors affecting the shape of the curve. The volatility of the copper price and the reasons for lower volatility of copper compared to silver. The various industries driving copper consumption and factors driving higher price. The global copper supply scenario and the bottlenecks. The impending structural deficit and the price outlook. The recent market signal, the methods of copper investing. The commodity pricing equation establishes the relationship between spot price, which is the price for taking immediate delivery, and future price for delivery on a future date. The future price is the spot price plus the burden of holding the physical item minus the benefit of having it in your own hands right now. So this is the future price, S is the spot price, and R is the risk-free interest rate, S is the storage cost, and C is the convenience yield, and T is the time to maturity. This part discounts down the future price to the present price. C is the cost of carry is R plus S, and this is the convenience yield. So future price equal to spot plus carrying cost minus convenience benefit. The cost of carry, this is why the futures are more expensive than spot price usually, a state called contango. Convenience yield, see, if there is a supply disruption, the value of holding the commodity now is huge. So C becomes large enough to exceed R plus S, that is the cost of carry. The value of C is subjective and perception driven. In such cases, the spot price exceeds the future price, a state called backwardation. The exponential function discounts future cost and the convenience yield to the present value. Copper futures are usually in contango, but they slip into backwardation at times, especially when the physical markets gets tight. An imaginary example of contango and backwardation. This is the graph is showing the contango and backwardation. This x-axis is the months from expiry and y-axis is the commodity price. This is the contango price curve, that is the future prices are moving above the spot price, and this is the backwardation where the future prices are moving below the spot price, and this is the spot price. Copper is an industrial storable commodity, so the future curve is typically upward sloping. Copper is usually in contango as storage plus finance cost is carrying copper forward costs more. Abundant warehouse stocks most of the time. No strong convenience yield when supply is comfortable. Copper does enter backwardation, but usually for fundamental physical reasons, not the financial ones. Inventory drawdowns at LME, SHFA warehouses. Mine disruption, strikes, weather, geopolitical issues. Sudden demand spikes like China restocking, energy transition demand, etc. In these cases, immediate copper is more valuable than the future delivery. The arbitrage traders prevent frequent mispricing of future price of any commodity relative to the spot price plus the cost of carry. How arbitrage traders work? If copper futures are too expensive, they indulge in cash and carry arbitrage. Buy physical copper at a spot, store it, sell futures, then deliver into the futures at expiry. This pushes spot up and futures down until fair value is restored. Futures is too cheap, backwardation beyond fundamentals. They indulge in reverse cash and carry. Borrow copper, draw from inventory, sell spot, buy futures, take delivery later. This pushes spot down and futures up. Arbitrage has restrictions like storage capacity limit, logistics cost, credit availability, delivery location, mismatch, etc. So can exist within limits only. Thus, arbitrage prevents future premium from drifting above the cost of carry and prevents spot from spiking without real scarcity. Arbitrage does not eliminate contango, backwardation, or curve-shaped differences across maturities, but puts a solid range to the spot future price spread. The usual forward premium for copper for 1 month contract is generally around $30 to $40 per ton, which on a spot price of around 12,000 works out to be around 3% annualized. As storage cost as a percentage of price value is higher for copper than for silver, so forward premium for copper is usually higher than for silver, even though other factors could turn the future price curves. Copper is less volatile than silver because it is an industrial necessity with deep inventories and predictable demand, while silver is a thin, financialized hybrid metal driven frequently by speculation and sentiment. The long-run annualized volatility of copper is around 25 to 30%. During supply disruptions, the copper volatility briefly jumps to 35 to 40%. The long-run annualized volatility of silver is around 40 to 45%. The demand for copper is almost entirely industrial, so demand changes are gradual and forecastable. Silver demand is 50 to 60% industrial, 40 to 50% investment demand plus speculation. The investment demand is highly volatile and cannot be accurately predicted. Copper has a large visible inventories, so supply shocks could be absorbed to some extent. Silver has small effective free float, as much of silver is locked up in ETFs, jewelry, long-term holdings. Thus, thin available supply creates bigger price swings. Speculation intensity is much lower in copper as it is mostly traded by consumers, producers, and merchants. The retail and speculative traders dominate silver futures. Thus, high leverage in silver trading amplifies the price moves. The speculation intensity is much higher in silver. Copper mines have strong lead time, so supply changes slowly. Therefore, during supply disruptions, the volatility spikes. Silver is often mined as a byproduct, so supply can respond faster or face unexpected disruptions causing high volatility. Now, copper is the bellwether of transition as it is the primary beneficiary of the AI and the green energy boom. Copper price has grown by around 30% year on year and has returned the CAGR of around 9% in 5 years. The US copper leads the global prices higher. As the red curve shows the US COMEX front month copper and the black curve shows the LME front month copper, just as the green one is leading the black one. The demand drivers of copper, grid and power infrastructure, projected to drive up to 60% of the demand growth till 2030. The AI multiplier, the data centers and defense heightened the need for secure energy networks. China is the largest driver of copper consumption, accounting for 50% of the global demand, but US and Europe are reindustrializing. The new age industries are the major copper consumers, so their growth will drive up global copper demand. However, it is very difficult to accurately forecast the demand growth. Future copper demand, the key growth sectors, EVs, renewables and data centers. Total global demand outlook projected to grow from 28 million tons today to 42 million tons by 2040, driven by these sectors. A potential supply gap of several million tons is forecasted by the next decade. Let's see the global copper demand supply scenario. This blue graph is the demand scenario and it is ahead of both high ambition and rocky road copper production, expected copper production. The global copper demand is met by mined copper and recycled copper. The major global copper sources are given below along with the tentative mined copper, as accurate production is difficult to estimate. The red spots indicate the major copper production hubs in the world: South America, Eastern Africa, Asia, US. South America accounts for the maximum share of the global copper supply. Chile and Peru. The estimated supply is around 34% of the global supply. Then Asia, China, Indonesia, Kazakhstan comes next. They are up for 22%. Then comes Central Asia, 14%. So this is the distribution of the copper production across the globe. Supply growth is constrained. New copper discoveries are relatively rare and development timelines for new mines are long, often 10 to 15 years. Existing major mines are aging with declining ore grades and higher operating costs, so slowing the production growth. Global copper reserves, economically extractable non-deposits, are estimated at about 950 million metric tons as of 2024. Broader resources, including less certain unmined deposits, are much larger, several billion tons, but reserves are what's economically viable now. Data from International Copper Study Group indicates that secondary copper production, that is the copper actually processed from scrap and fed into the refined output, accounted for around 16 to 17% of the total refined copper output in 2023-24. The multiple authoritative forecasts point towards a structural copper supply deficit globally over the coming years and decades rather than just a short-term cyclical shortages. Demand is accelerating rapidly. Electrification, renewables power grids, electrical vehicles, AI data centers, and broader industrial growth are fueling copper demand growth around 2 to 3% annually and potentially much higher over the long term. Supply growth is constrained. The copper recycling is bound to increase to fill the growing supply gap. Long-term structural supply gap. Standard & Poor's Global and the International Energy Agency highlight a potential copper supply gap reaching 10 million tons annually by 2040 if current trends continue, even assuming increased recycling. That gap could represent roughly a 20 to 30% shortfall relative to demand by 2035 to 2040 without substantial new supply. Many experts believe that the world is heading towards a structural copper supply deficit, one that goes beyond the normal market cycles. In the near term, 2025 to 26, modest yet real deficits are expected. In the long term, 2030s and beyond, demand could significantly outstrip supply unless investments in new mines accelerates, recycling infrastructure expands, substitution and efficiency improvements reduce copper intensity. Forecasting metal price accurately beyond 12 to 18 months is very difficult. However, the range of expected copper price for 2026 is 11,000 to 13,000 tons. The predictability horizon, the sweet spot for forecasting accuracy is 6 to 18 months. It is this period where the forecasting accuracy is high. In the short term, the error and noise part is quite high as the prices are quite erratic. In the long term, the structural forces take over. The long run, the prediction accuracy goes down as the structural forces become important. The following factors in addition to demand and mine supply will drive copper price. Financial and market sentiment factors. High interest rates can slow economic growth and demand. A strong US dollar typically puts downward pressure on dollar-priced commodities like copper. Speculation and financial flows. Futures markets and ETF investment flows can amplify the price moves. Positive price momentum indicates speculative long positions and vice versa. Hedged by producers and consumers. Forward selling by producers or buying by consumers can influence price dynamics in the futures markets. Copper scrap and recycling rate. Higher scrap availability increases supply without new mining, especially in the slower market periods. But scrap availability tends to rise only gradually. The demand and supply forces indicate possibility of a long-term structural deficiency. The demand side factors. Global economic growth. Copper demand is closely tied to industrial activity. So strong GDP growth equal to higher infrastructure, construction, manufacturing output equal to strong copper demand. Electrification and EV adoption. Rapid EV penetration and expansion of grid capacity boost demand disproportionately relative to the economic growth. Construction and infrastructure spending. Copper is widely used in buildings, plumbings, and electrical wiring. So large industrial packages, especially in major economies, can significantly support demand. Inventory levels and exchange stocks. Inventories in LME, COMEX, and SHFE warehouses act as buffer. So low inventories signal tight physical markets and support higher prices. Tight fundamental balance plus low inventories equal to prices can spike quickly. Weak economic data or strong dollar can counteract tight supply and soften prices. Now the supply side factors. Mine production trends, operation challenges, strikes, water restrictions, power issues at major copper mines affect availability. So delays in new mine projects or expansions tighten supply. Smelter and refiner capacity. Even if ore output increases, limited smelter/refining capacity can constrain how much refined copper enters the market. Energy and input costs. Copper production consumes significant energy. High electricity or fuel costs increase production costs and can pressure producers to curtail output. Geopolitical risks. Political instability in major producing countries. Chile, Peru, Democratic Republic of Congo can disrupt supply. Supply disruptions with strong EV clean energy demand leads to sustained upward price pressure. The recent market signals and the methods of copper investing. The recent market signals. Inventories at the major exchanges remain historically low, thus creating a strong bull case argument. Several mine expansions are delayed. EV and renewables demand continues robust growth. These reinforce near-term price risk to the upside unless demand weakens significantly. Since copper in India is priced in INR, so rise in USD INR rate could increase domestic copper price. As USD index looks weak, so fall in USD index generally results in rise in international copper price. The global fiat currency debasement rate has resulted in surge in prices of precious metals. Now, due to funds rotation, some funds may flow to copper and other commodities, as commodities do not have any counterparty risks. Now, the methods of copper investing. As storage cost of copper as percentage of price is quite high, so there is no ETF in India which buys and stores copper. Copper futures could be traded in MCX, but usually those have a negative cost of carry. Option contracts on copper are also traded in MCX. One could invest in copper mining companies like Hindustan Copper and Vedanta. One could invest in overseas copper funds through liberalized remittance schemes. As talks are going around of allowing copper ETFs in India, as copper storing has a negative annualized cost of carrying of just 3 to 4% annually. In the world where liquidity moves much faster than changes in fundamentals, the short-term price movements and volatility could be caused by paper transactions. So this concludes the presentation on the copper price outlook. Thanks for watching. Jai Guruji, Shukrana Guruji.